Hello, Jeffrey Christian. It's about 2 o'clock on Thursday, the 8th of December. I'm recording this for release on Friday, the 9th of December. I will be out of the office, so recording a little bit early. What I want to talk about today is not particularly time sensitive, so there won't be much of a difference in 12 hours or whatever. I want to talk about U.S. political will, and it's a subject that I've talked about for decades, and what it matters to gold and silver. And then I want to go over some current issues and data that has come out on gold and silver related to gold, Russian gold and the central bank, UK gold and silver inventories, and UK silver exports. Now, the main thing I want to talk about is the current state of the U.S. economy and society and political structure. We all know it's bad. There are major issues. And this is federal debt. You can see back prior to 1980, it was less than $1 trillion. It's now well over $30 trillion. It's a problem. But the real problem, a bigger problem, is the federal deficit, which I'll show you in a second. And the deficit feeds the debt. You have to fix the deficit in order to fix the debt. And it can be done. We've talked about it in the past. We'll talk about it today. We'll talk about it in the future. The major limitation is a lack of political will to do what needs to be done. And it's very sad because what needs to be done is actually relatively painless. It's totally painless for like 99% of the US population, and it's relatively painless for everybody. We recently saw in the recent by-elections in Massachusetts, they passed a extra tax for investors or people, taxpayers, earning more than $1 million. And Democratic politicians were surprised that small business owners in Massachusetts didn't mount a strong effort to try to get people to vote against that. Partly it's because I guess most small business owners probably don't earn $1 million in a year. It's a small percentage of people who earn that much in a given year. And the second thing is, adding 3% taxes to somebody who's earning $1 million or more. That's $30,000. It's a lot of money for most of us. But if you're bringing home $1 million every year, it's not all that painful. So the problem that we face in fixing the economy in the United States and the federal deficit and federal debt is that politicians are pandering to money, to corporations, and to wealthy individuals. And part of that I've addressed in the past, looking at who owns those offshore treasuries. There's a vast majority of U.S. treasuries which are bearer bonds, and no one really knows what they are. People talk about them belonging to the People's Bank of China, which is not necessarily true. People's Bank of China, among central banks, People's Bank of China is like 4th or 5th in terms of the amount of U.S. treasuries it holds. Japan, the Netherlands, and the UK all have much more. But there's all this other stuff that's unknown. And economists think that maybe 1/3 of offshore U.S. treasuries, maybe more, are actually held by U.S. corporations, institutional investors, pension funds, and individual wealthy individuals as a way of avoiding taxation. And those people are the ones that you have to worry about. People mistakenly say, well, what if China wants to dump its treasuries? Well, it hasn't been dumping its treasuries. And it doesn't necessarily want to dump its treasuries for a variety of reasons I won't bore you with. But that's not the risk. The risk is that politicians grow spines. They say we have to do something about taxing corporations and wealthy people and institutional investors. And then those guys say, well, then we're going to dump some of our offshore treasuries. And that's the real risk to the treasury market. It's not China, it's not Japan, it's nothing else. It's really offshore holdings of U.S. entities. So you've got this U.S. Treasury debt, and that's the problem. And the solution is political will. Now, we've fixed our debt problems before. And in 2011, during the Occupy Wall Street, I actually wrote a piece and gave a talk to people over at Zuccotti Park about what I called 5 easy pieces. And it was 5 pieces of legislation that would have a minimal negative impact on U.S. entities, people and corporations, but could actually twist from what was then a $1.3 trillion debt to a surplus. Not $1.3 billion debt, $1.3 billion annual deficit to a surplus. And people continue to ask for copies of that. And a very prominent silver promoter asked me just last year, hey, Jeff, that piece that you wrote back in 2011, 5 easy pieces on solving the deficit problem in the United States, could I have a copy of it? I want to refer to it. I haven't updated it, and this is not 2011. Things are much bigger. The deficit's bigger, the debt's bigger, and things are quite different now. In 2011, we had a $1.3 billion deficit, but it was a temporary deficit over several years coming out of the global financial crisis and the Great Recession of 2007, 2009. And it was perceived that it would fall as the economy recovered. And it did. It fell back to about $450 billion a year deficit, which was outrageously high, but it was less than half of what we had seen for about 3 years starting in 2009. Things are different now when we have a deficit that is much more persistent, and it's problematic. This is another way to look at the federal debt. Again, from Washington to Carter, in 1980, we had $1 trillion in debt. And then it rose. Reagan and Bush got it up to $4.6 trillion. And we said, this is unsustainable. And people were saying, this is unsustainable. The Treasury is going to collapse, and gold prices are going to 10,000, and silver is going to 500. And then under Bill Clinton, it got up to 5.6 trillion. And we had people saying, no, this is unsustainable. And then under George W. Bush, it got up to $12.3 trillion. And his vice president, Dick Cheney, famously said, deficits don't matter. And then Obama got it up to 20 trillion. And Trump got it up to 28 trillion. And it's up to 31 trillion now, so far, 2 years into the Biden. So you can see, this is not a Democratic and Republican issue. All politicians are responsible for our deficits and our debt. And I've often said, I've often criticized the Democratic Party, and with good reasons. And one of the things I've said is, they're really not a party. The Republicans say, well, the Democrats are the party of tax and spend. And if you look at this, and the red are Republican administrations, blue are Democratic administrations. If you look at this, you see that Democrats are the party of tax and spend. Republicans are the party of borrow and spend. We actually had surpluses for 3 or 4 years under Clinton, paid down the debt about $1 trillion. Was so confident that we actually got rid of the 30-year T-bond for a while. If you look at this, you can't really see it, but in 1969 was the last LBJ budget, and there was a surplus. And prior to Clinton, that was the last surplus that we saw on our deficit, our annual deficit of spending versus income in the government. So it's a party, it's not a partisan problem, it's a political problem. And you can see here the gray area is the CBO's nonpartisan estimates of what the deficits are going to be. And you can see, whereas we had 2 years of trillion plus deficits in we had about 3 or 4 years of trillion-plus dollar deficits in the global financial crisis. We've had 2 really big ones. We've had 4 over $1 trillion. And the CBOC says, unless the politicians change the way they do things, we are facing trillion-dollar deficits for at least the next 10 years, regardless of which party has the White House, regardless of which party has the Congress. But the political system has the capacity to save the economy if we only had the willpower to do so. And again, this time is different. I use this list of problems that our world and the United States are facing a couple weeks ago. It's different. It's different by degrees. Things are worse than they were in 2011. And it also may be different by structure, because we're into a structural $1 trillion plus. Dollar, not dead yet. I used this a couple of weeks ago, maybe last week. And in fact, there are any number of sober economists who look at currency markets and say, if the US got its house in order, you could actually see the dollar preserve its status as the de facto reserve currency of choice and the financial asset currency of choice for an extended period of time. If you go back here to the 1980s, 1985, the dollar peaked. It had been falling from the time it was freed into 1980. With the double dip recession and financial crises that we had in 1980 through 82, the dollar started rising. Things were worse in Europe and Japan, and it rose into 1985. And then 1985 to 1987, it fell and fell sharply. And then it continued to decline into 1994. And as the Clinton administration started taxing stuff and increased the marginal tax rate slightly, and found fees for our services that the federal government was providing, we actually, as I said, turned surpluses for 4 years. And there were people say, oh, those numbers are inaccurate, but ignore them. This is the data. And you saw the dollar rise sharply because people around the world and governments around the world said, the US has good actuaries in the Treasury, and they know exactly what they can do, how much they can raise taxes to pay down their deficits and pay down their debt without throwing the country into a recession. George W. came along, and we went down, and we stayed down into 2007, 2008. Basically, we're pretty much flat until about 2015, and we've started rising. And it is possible that if we found a way to unify our political will, we could actually turn the deficits around, pay down the debt, and find the dollar being the de facto currency of choice for an extended period of time to come. But that's another subject. And again, that's through October. If you look at the decline in November, it's relatively small in the greater scheme of currency exchange rates. Now, I want to talk about political will, because as I said, we've turned it around before. And I've talked about a couple things before. The first one is the US election. In 1933, we were in the depth of the recession. 4 years into it, something like 30% or 30% plus unemployment, foreclosures everywhere, companies closing. It was really bad. And FDR was elected. The inaugural committee said, the country is so divided, and there's so much anger at the extremities of both sides that you shouldn't have a parade after your inauguration. There's a tradition to have a parade from the Capitol where the inauguration occurs to the White House. And FDR insisted that they have one. So the Army lined Pennsylvania Avenue with machine gun nests trained on American citizens who had come out to watch the inaugural parade. That's how dangerous the political environment was in 1933. And yes, you had the America First and Make America Great Again, Nazi and fascist movements that had campaigned against FDR, and they were loose in the country. When FDR got to the White House after the parade, the first thing he did was he declared a bank holiday because there had been a massive run on the bank, people taking money out of banks. He closed the banks for 4 days. When he reopened the banks after 4 days, there were massive lines around in front of banks across the country of people seeking to redeposit their money in the banks. Something had happened in those 4 days, and probably actually before that, to take the political will of American citizens from, oh, the country's falling apart, maybe somebody's going to shoot the new incumbent president, I got to get my money out of the bank and put it in gold and cornstarch and other things that I might need to eat, to, hey, let me redeposit the money. We're going to be okay as a nation. In 4 days, you had that pivot. FDR had said he was going to ask for gold to be turned in because as people took their money out of the banks, shrinking the investment and lending capacity of the country, they were putting into gold. He didn't issue that order until April 5th, like a month after he had closed his inauguration and he had closed the banks for 4 days. Everyone knew he was going to do that. The Treasury estimated there were about 58 million ounces of gold coins and gold certificates and physical gold in the U.S. economy. And 40 million of it was turned into banks for the U.S. Treasury, for delivery to the U.S. Treasury, before that decree actually was issued on April 5th. About 87% of the gold that was ultimately turned in, about 70 some odd percent of the gold that was in the country was turned in before the gold executive order was turned in. It wasn't a confiscation. There were never any Treasury agents or police or G-men or T-men going through people's homes or offices or bank deposits or safety deposit boxes confiscating gold. It was, we want you to turn in your gold. And you could keep 2 gold coins from every annual mintage under that the U.S. government had. So you can keep a fair amount of gold for the average investor and citizen, but turn in what you don't have. And without any physical coercion, people turned in 40 million ounces before the decree was issued, another 6 million ounces after the decree was issued. There's about 8.2 million ounces that weren't turned in, and the Treasury estimated that, well, a good portion of that was actually exported, and some of it was kept in those coins, 2 coins each, and some of it was kept against the decree, but one person was prosecuted for defying the decree. And that was because he made a public spectacle of it. And he said, I think he said I could stand in Fifth Avenue and buy gold coins and no one would do anything about it. No, he didn't say that. He said, I'm not going to obey the decree. And I dare the federal government to come and prosecute me. So they did. It's like, someone once said to me, so sue me. So I did. And he said, why'd you sue me? I said, well, you told me to. That is political will. Compare it to the prohibition, where you did have federal marshals, police, and Treasury agents going through homes, offices, and bank safety deposit boxes looking for liquor and pouring it down the sewer when they found it. A senseless waste of human activity. Here's another political willpower thing. The orange line is U.S. federal debt as a percentage of GDP. It's now over 120%. It was over 120% in 1947. Coming out of World War II and coming out of the recession of 1947, the US government had racked up an enormous amount of debt. You can see at the onset of World War II, we had about 50% of GDP represented by federal debt. But it went up to 120%. And Truman and Eisenhower and Kennedy and Nixon and Ford and Carter said, we got to pay this down. The marginal tax rate, the tax rate on the highest group of taxpayers in the US was 90% under Truman and under Eisenhower. There are all kinds of tax breaks that you would look for because you were paying 90% of your wealth, but people did it. Kennedy dropped it down to about 61%, I think. This looks more like 70%. And it stayed there through Kennedy, Johnson, Nixon, Ford, and Carter. And we took our percentage of GDP in federal debt from 120% down to around 33%. And those were the glory days of the US economy. Those are the go-go days of the 50s and 60s and the wild days of the 70s. Reagan came in and he slashed the debt to 50%, and then he flashed it to 24%, I think, 28%. And lo and behold, the US federal debt as a percentage of GDP started rising. And since Reagan, we've kept that marginal tax rate below 40%, and our debt as a percentage of GDP has gone from 30% to 124%. People in the 50s and 60s and 70s, voters, citizens, had the political will to vote for and re-elect politicians who were saying, I know this hurts, but for the greater glory of the United States as a nation, as a country, and as a government, we need to keep tax rates high. And politicians had the political will to say that. I know I'm running for a re-election, but listen, hey, I got to do this. That's political will. It's missing today. The politicians don't have it. The voters don't have it. It's absent. And there's nobody readily available with the among our apparent leaders to stand up and say, let's restore the comity that had that generated that political will to do what was right for the country and all of the citizens in the country instead of just us. That political will's absent, and as long as it's absent, gold and silver will make sense as investments. That's really the key for anybody who's interested in gold and silver of all of this. We don't have a political structure that's geared up to make the United States good. We definitely didn't see it in the Make America Great Again administration. That was one of the more self-serving governments that we've had. But we haven't seen it in any other government since Reagan. And until we do, buy gold and silver. Now, gold and silver, they came off of their November's lows, October lows. They rose during the course of November. They seem to be consolidating at the high end of that range. There's the potential for them to fall back, but we think that the tide has turned, and we do think that the prices will rise modestly in 2023 and more sharply later. We say modestly in 2023 because there are a variety of factors, both fundamentals in the gold and silver markets and economic and political factors that we think will serve as headwinds to rising prices. But we do think that the lows are probably behind us now. A couple of words on gold and silver I wanted to talk about. One is There is a National Defense Authorization funding bill that's winding its way through the Congress. They want to get it passed before they go on their year-end recess. And it has a clause that's been added to it that would prohibit U.S. entities, any kind of corporation, from trading gold with the Central Bank of Russia. So what does that mean? Well, first off, understand, U.S. entities really don't do a lot of buying and selling of gold with Russia. They did in the distant past when it was the Soviet Union and in the early days of Russia. But over the last 14, 15 years at least, most of the trading with Russia, and even before that, was done by Swiss banks and British banks and British subsidiaries and affiliates of U.S. banks. Since 2008, Russia's been buying gold. As the oil price rose, they had excess foreign exchange reserves, and they had the capacity to take the dollars that they were getting paid for their oil and gas exports and convert some of it into gold. But the gold they were buying from Russian banks, and it was Russian mined or refined from scrap. It was refined in Russia by Russian refineries, either from ore that had been mined within Russia or the other former Soviet republics, or it was being refined from scrap electronics, scrap jewelry, and things like that. So the Central Bank of Russia hasn't been buying gold from the United States banks or other entities for a long, long time. What this really is something looking forward, which is saying, well, as Russia devolves, because it's really spending a tremendous amount of money on the war and it's got problems with its exports, earnings, and such, maybe they will have to sell some of their gold. And if they do, we don't want U.S. banks or brokerage houses or private equity shops being the buyers of it. Our own view is that the gold is probably the last thing that the Russians are going to sell. But the reality is that it's pretty much the only thing they have to sell in terms of fixed assets that are in their hands. They're still living off of exports. And with higher oil and gold prices, they have been able to compensate for the sanctions that have been placed against them since they invaded Ukraine. So it's kind of on the surface, you say, well, this is kind of a paper bag here, empty bag here, because U.S. banks, the Central Bank of Russia doesn't trade with U.S. banks. They mostly trade with Swiss banks. But this is a forward-looking piece of legislation. The other two things I wanted to talk about, London depositories. The figures for November came out today. And silver exports by destination from the UK. I showed you gross exports and imports in our last video on Tuesday. I'm going to break it out a little bit more. London depository holdings, they were off 1.5% month over month during November. They fell to 295 million ounces. And silver inventories were off 1.4% to 840 million ounces. This is a continuation of a steady draining of these depositories for about a year now. Most of this gold and silver is actually going to investors around the world and to fabricators. A lot of the silver is going to fabricators. A lot of the gold is going to some fabricators, but more to investors. Where the silver went when it left London. Through the first 8 months for which we have UK trade data, India was the largest destination for silver exported from the UK, 129 million ounces. The next largest destination was Canada at 69 million ounces. I'll come back to that in a second. Switzerland 28, Turkey 21, Spain, Germany, United States. The Canadian number has some amount of metal, probably the majority of it, actually coming into the United States. But because of shipping problems, those, whatever they call it, supply chain disruptions, it has been easier and faster and cheaper to ship silver from England to Canada and then truck it down into the United States from Montreal. So you had these large numbers of silver coming into Canada, but a lot of that actually ultimately is destined for US. And most of what is destined for the US is destined for fabrication demand. I think that's about all I'm going to talk about today. I've already gone way too long, but I will invite you to tune in next Wednesday, 10 a.m. Pacific time, 1 p.m. Eastern time. Metallic group of companies, Metallic Minerals, Stillwater Critical Minerals, Granite Creek Copper. So you've got silver, gold, platinum, group metals, cobalt, copper, nickel. Those three companies are going to have a live webcast on the 14th of December, next Wednesday. And they asked CPM Group for me to be there for some discussion of the markets for all of those metals and the economic environment as it's going to affect metals markets in 2023. So I encourage everybody to plug into that live webcast. You can hear a little bit more about what CPM Group thinks, but you can also learn about three very attractive and interesting companies in our mind. And then you can go to our website and read about our stuff. Sorry I talked so long, but I guess there was a lot of ground to cover. Have a good weekend. Take care of yourself and those around you, and I'll talk to you next week.